Welcome, welcome. Beautiful day out here in sunny South Carolina. I know beautiful day from Chicago too. And let's spend a little bit of time looking at the market today. I'm going to basically talk a little bit, few minutes about the market as far as my planned outline today. And then I'll look at a couple trade opportunities. First, I'll look at a credit spread, and then I'll look at a calendar opportunity. So let's jump in. So as we see the market right here, again, we're still in a nice uptrend over the 200-day moving average. And I think I will focus on most of the last month, which entails this information. That's probably more applicable to our trading. If you look at over the last month, SPX is between 29.22 and 32.33. Again, right now as we speak, SPX is at 30.95 and VIX is at 33.63. And we're near the lows of the day. We have quite a bit of a range today, right? We're near the lows of today near 30.91. The high today is 31.55. So, about a 60 points we've dropped off the high of the day, right? So again, the last month VIX has been 29, 22, 32, 33. So we're still a little bit in the higher end of the range. This is very normal today, right? Right? Coming down a little bit. We've gone up pretty quick most of the last, good part of the last month. The VIX over the last month has basically been between 24 and 44, kind of close to the middle where we are now. Again, Dan's range for the last 2.5 months, and I'm still there. I think we'll continue there, is about 25 to 40 in the VIX, and that's kind of driving what strategies that I'm looking at. Again, a typical correction, if you look at like the last correction we had in 2018 at the end near Christmas, where we were down 25%, it took about 3 months to unwind out of this. And if you look at this correction that started maybe in towards the end of February, or 4 months into it, towards the end of June, I think we'll continue in this near 25 to 40 VIX, kind of a higher VIX level versus historically, at least through August, September. You say, why? Well, because I think there's more factors involved in this correction, don't you agree, than there were in 2018. And until there's some kind of something definitive in the coronavirus situation, there's too many things looming, right? What's in the paper today, all the cases have gone up at different places in China. So again, this is, excuse me, this is going to take a little longer to unwind, right? So, if you're expecting us to go to the highs of 33.93 quickly, I don't think so. It could happen, but again, I think there's things going on. It's going to be a process. Petru says Apple's closing back the stores. Yeah, it's a process, right? And we're naturally impatient people, right? Get the correction over in a minute, boom, let's go up. So with that being said, again, we're looking. We've been doing a lot of different stuff. A lot of your income trades have been working pretty well. but we're doing some different trades, calendars and stuff. And so today I'm going to talk two trades that have been working pretty well, and I'm going to talk about them. And two trades I would consider even today, right? Trade number one would be a credit spread. Anybody do put credit spreads the last week or two? Anybody do put credit spreads the last week or two, or any kind of credit spreads? Petru says just flies. Well, yeah, we've been doing put credit spreads, and they've generally been working pretty well, right? Last month or two. Why? We've been going up, right? We're in an uptrend, right? Of course. So here would be an example of what I would be looking at. Again, the market is continuing to go lower, right? Again, we've got about a 60-point range today. So with the market lower, this is typical. I'm looking at a 21-day put credit spread. Kind of like them. And here'd be an example of one right now that I'm kind of looking at. Maybe in the next hour or two, sell a 28.70 put. Again, I'm in the July 10 expiration, 21 days out. And buy the 28.60 puts and a 21-day put credit spread where the delta of the short is about 20. It's going for somewhere around $1.45, $1.50. Does that change a lot if the volatility changes? Not really. What changes is the strike, right? Like this is your graph at expiration. Excuse me, that's your graph today. And this is your graph at expiration. This is a TD Ameritrade Thinkorswim. So for 21 days out, I would look to be in this maybe 10 days. The short strike is at 28.70. So this is about 220 points out of the money. And so if we're looking for around, let's call it $1, close to this, $1.50 credit, because we're doing 10 wide credit spreads, your risk is $8.50. So your potential yield at expiration, the most you can make, 150 divided by 850. It's about 17% potential yield. And I'd be looking for this particular trade, not that I do all credit spreads like this, but maybe half of this. So about 8%. So if I'm looking for maybe 8% at 850, be about $65, $70. So if I sell it at 150 and buy it back at 80 cents debit, again, 80 divided by my capital or risk of 850, I'd make a little over 8%. And then I'd put probably, I don't want to lose more than 12%. 12% on 850 would be somewhere around $100. So if this $1.50 credit gets to, this would be for a profit. This would be for a loss. If the $1.50 credit gets over $2.50, I would exit. It's a very simple risk management plan. Again, as we talked about in our credit spread class, where usually you'll get a max loss when you're down 12 to 15% will be when the delta of the short put, if we do it at 20, when it goes up about 15 to 35. And so again, I kind of look at put credit spreads, and again, is more of a, I look at maybe a little different than some of you. Some of you probably look at credit spreads, a little more directional than I would. Okay, if we're near resistance, I'll do the call credit spread. If we're near support, I'll do the put credit spread. Nothing wrong with that. More speculative. I look at this more intentional, that more than not, I would do the put credit spread because of the volatility skews. You can get more room on the put side for a 20 delta than you can on the upside for a 20 delta, right? Because the volatilities are higher in the puts than the calls. So I would look generally to the puts, but I'm more intentional, and then I'm looking at the view of an investor. The market will be up over time, so intentionally I'm looking, unless the market looks terribly overbought or near really strong resistance or something, I'm doing the put credit spread intentionally every week. And so that's what a 21-day, the only thing that changes if the volatility goes up or down, your credit's going to be about the same. It's just that you get more distance as the volatility goes higher. We're getting 220 points from the price to our short strike. If vols go up more, we'll get more room to the downside. If volatilities go down, we'll get less room. So that's a put credit spread. Again, your Greeks, you're barely almost a delta long. You have some positive time decay, and you benefit. Your short Vega, you benefit if the volatilities come down. Any questions on this? I think, and again, it's something I'd probably consider today. We're down, off the highs of the day. We're down almost 70 points, right? So something I might be looking at now. And again, here's the other thing. How many of you have ever scaled into a trade? It's not always an all or nothing. You know what I mean? Let's say we're deciding who would be comfortable doing let's just get a yes or no. Who would be comfortable doing a put credit spread right now? Yes or no? Just give me your honest opinion. Yes or no? And, with the market going down, it's tougher. But would it be an easier question if I said, hey, let's say you normally do 2 contracts for a put credit spread. Would it be an easier decision to say, would you do 1 contract now? In other words, would you scale it, right? Sometimes that's an easier decision. Or let's say when I do put credit spreads, I do 10 contracts. Well, maybe to do the whole 10 when we're down 28, I might say, well, we could be down more. Well, could I do 3 right now, right? I could do that. David says, define risk okay, make it 5 wide instead of 10. You could, again, depending on the capital you want to trade, 5 wide is going to be cheaper dollar-wise than 10. 10 would be cheaper wise than 20. It depends on how much capital you want to put out there, right? But again, whether you trade credit spreads, butterflies, whatever, you have to have an intentional plan, right? And every strategy that you do should be a profit center. If I'm doing credit spreads, I look at it, okay, I'm trying to make 1,000 a month or 3,000 a month or 5,000, whatever the number is per month on my credit spreads. And that will dictate how often I trade, what's the size, maybe what's the width of the spread. So I think everybody should have a number. Otherwise, you just kind of flown around by the wind, right? I mean, even if you're newer, say, hey, I'm trying to make $200 a month or $200 a week, that will dictate your size and everything else. So I think an intentional plan, right? In other words, you're not going to intentionally make $3,000 a month by winging it, right? So anyways, that's one. Another trade I'm looking at is something we talked about earlier in our sessions in Sheridan mentoring, would be a calendar. Here's one I'd be looking at, possibly even going over the weekend. So here's an example. and we'll talk about this. We don't normally do short-term trades and going over the weekend, but we're discussing a little bit on this today, and I'll just share that a little bit of that discussion with you. So here's an example. I'm buying one June 29 3085 calls. It's kind of closest to at the money. Selling one June 26th. They expire in 1 week. So this is a 7-day calendar, 3085s. And this calendar is going for, it's moving around right. I mean, here's where we're at, 3084. And this is going for maybe $5. It's moving around, but we'll say close to $5.30 debit. I only put 3 days between my long and my short because with VIX at 34.44, historically, we're still high, right? I mean, over the last couple months, this wouldn't be considered really high, but it's for calendar trades, which benefit if the volatility goes up. I'd rather reduce my volatility exposure because I still think volatilities are a bit high. So by keeping the distance from my long and my short very narrow at 3 days, that limits my volatility exposure. But you can see the Greeks here on a spread that costs about $530. 1 day of theta is $67. So 1 day of theta is, if we take, 60 bucks divided by the cost of the calendar, which is, let's say 530, 1 day of theta is about 11%, right? So this is something I'm considering in smaller size than normal. So let's say if I do 10, maybe I look at 3 today or something. I'm looking at the end of the day, put it right on at the middle, right? And, we got a lot of theta. If I look at this trade on Monday's date, if I look at this trade on Monday's date, which would be the 22nd, right? 20, 21, 22. Look at the theta on Monday's date, $111, but you could see, look at the room we have. If I set the short strike kind of in the middle, right now we're closer to 3085. But at the end of the day, if I put it kind of at the money, I've got, if you look at where I would lose money on Monday's date, basically I've got probably over 100 points on the upside and close to 90 points on the downside. So could I absorb a good gap Monday morning? Yeah, if I put it in at the money. So again, when you're doing a 7-day calendar, your biggest risk is price risk. So that's why I would center it right at the money, right? And, but again, because anything can happen over the weekend, I would do smaller size than normal. But I mean, again, can it absorb a pretty good move? Yes. And my goal would be get out of it Monday. A question says, would I consider going out further a few days on your put? They're both puts. Do you mean on my long put? The answer is no, I would not. No, I like it. I like it as 7 days for my short because it gives me a ton of theta. I'd be looking to get out of this Monday. And I looked earlier, maybe a 7-day versus a 12 or 14 day. I like the 7-day. Anyways, those are a couple ideas that I'm looking at right now, maybe in the next hour of trading. And the only other thing, just to keep you updated, if you're interested, if you like what we teach at Sheridan Mentoring, you can come to our front page, SheridanMentoring.com, and you can get $49 for 1 month of our education. You can check it out enjoy everything, see how we navigate through the market over the next month. I think that'll be a great education for you. The other thing you can always check out are, if on the front page you click on online option courses, you can see there the vast array of classes. We do basically a new class every month. This is the class that we're just finishing up in the next week and a half. It's been a great class, credit spreads. If you're looking to become a good craftsman at one strategy, or you can check some of the portfolio classes on demand. And these are some of the individual strategy classes that we've recently done. And you can make your, you could check that out. So anyways, any other questions? If not, we're going to have a wonderful weekend. Keep working on the craft. As we speak, SPX is 3089, down near the lows, near the lows of the day. So, all right. Have a wonderful day, everybody. Thank you.